Welcome to another video on this channel. Today we are going to look at why staying invested during stock market crisis matters. So you must have heard on this channel as well as many other mutual fund advisors that when the markets are crashing, when there is a steep fall in the market, you should not panic. You should keep your investments intact. You should not redeem. And we will see why this advice has been repeated so many times by so many different people. There is a data backed basis for this advice. Right. My name is Paresh. I am an NISM certified and AMFI registered mutual fund advisor and distributor. This is my ARN 334516. Before we move ahead, this disclaimer is very important. Mutual fund investments are subject to market risks. You need to read all scheme related documents carefully. The past performance of any mutual fund scheme is not necessarily indicative of its future performance. So let's go back to March 13, 2020. Right. So on March 12, 2020, this was the peak of Corona. The stock market crashed by nearly 3,000 points. It was the Sensex we are talking about. Right. All the indices were deep in red. If you look at the news channel coverage back in those days, there was panic all over the world. And this is true not just in India, but all over the world. The news media, the newspapers, the news channels, the social media was just completely in panic, and rightfully so, because if you just remember what was the situation back in March 2020, it looked as if the entire world is coming to an end. So if that is the case, how would stock markets continue to function? And these were some of the typical headlines in the newspapers next day. These are front pages. Look at the Times of India front page. World War C, Sensex crashes by 2,919 points, by far its worst ever. Asian Age, Corona wipes out 11 lakh crores. And these are just some of the typical headlines, right? If you look at all other newspapers, not just in India, but all over the world, the headlines were pretty much similar. The Corona wipes out so many billion or trillions of dollars from stock market wealth. Investors lose so many $1 billion and all that. And these kind of headlines keep repeating whenever there is a huge stock market crash. So when earlier this year, I think in April, when President Trump announced his first tariff tantrum, similar thing happened. Stock markets all over the world crashed by a record. I think probably the second biggest record after what happened during Corona, and the news coverage was also similar. Right. So if you were, let's say, a mutual fund investor in March 2020 and you saw these kind of headlines, your first instinct would be to run for safety. Right? So redeem all your mutual fund investments and move that money to a bank account, because who knows, that was the time when there was no job certainty. I mean, even today it doesn't exist, but that was like the peak of job uncertainty. Nobody knew if the company that they were working for would even continue to exist, and it was quite a natural reaction for mutual fund investors to redeem all their equity mutual fund holdings, or even debt mutual fund holdings for that matter, and move all that money to their bank account. And maybe some of them did, and this was true for investors, retail investors all over the world. And this is an excellent study. This is perhaps the most insightful and the most interesting study about mutual fund investments that I have read so far. I suggest you pause this video at this moment. Have a look at this graph, understand what is the message that is being conveyed, read everything. Almost everything on this slide is comes from Vanguard. It's one of the leading mutual fund companies in America. Okay, so I hope you have looked at the graph. So I'll just explain what the study is about, right? So what Vanguard, the researchers at Vanguard did a thought experiment, right? So they assume that, let's say if somebody, an equity mutual fund investor, okay, during the market crash of March 2020, let's say that investor redeemed all their equity mutual fund investments and kind of put them in a bank deposit or in a liquid fund, And when the markets started recovering in July 2020, they moved their investment back to the same mutual fund, the same amount in the same mutual fund. This is how their investments would pan out. So the people who moved out their equity mutual fund investments into bank account or liquid funds and put them into the same mutual funds after the market started recovering would have made a return of minus 2% by the end of December 2020. So their investments would have returned a negative 2% over the next 2 years. But the investors, mutual fund investors who kept faith in the market, who did not redeem their investments, and their returns are represented by the blue line above, they would have made a gain of 21%. See, this is a very, very powerful analysis, right? And they have considered the MSCI All Country World Index (ACWI), and this index covers almost 85% of listed equities. So, which means it broadly covers Indian equities also. So, this analysis, although it is done at a macro level, at a global equity level, some part of it is representative of the Indian stock market also. So, this analysis is somebody would were to do this kind of analysis here in India, I'm sure the results would be similar, right? Just understand the significance of it. You had withdrawn your money from the market just for a few months, right? So you redeemed all your investments in March 2020. If you are looking at the brown line, in March 2020, when the market tanked to its lowest or recorded its one of the worst falls in history, if equity mutual funds had redeemed all their investments and moved them to a liquid fund or a bank deposits only for 2 months, 2 or 3 months, right? So they came back into the market in July 2020. So your money was out of the market only for 3 or 4 months, or 4 or 5 months, right? And even if you invested the same amount of money back into the market, into the same mutual funds, this is the difference in returns that you would see. Somebody who kept faith in the market, somebody who did not panic, somebody who did not redeem their investments would have seen a return of 21% over the next 2 years, while people who panicked and redeemed their money from the market, from the equity mutual funds, uh, saw a return of minus 2%, even if they put back the same amount of money into the same schemes. That is the central message, and see how important it is. So, that is why a lot of mutual fund advisors, a lot of investment advisors keep repeating this, that, you know, time in the market beats timing the market. There could not be any better example of an analysis to prove this. Just 3 or 4 months out of the market, this is the kind of returns that you get. uh, See, the stock market rewards disciplined investors. This has been proven time and again. This is the very basis of value investment philosophy. This is the message which has been given out by all time great investors like Warren Buffett, Peter Lynch, and many others. And a lot of times we keep hearing this, but we do not understand the significance of it. Right? Almost every mutual fund investor has heard this, that you need to have a long term orientation in the stock market. You need to, you need to have patience, you need to have faith in the market, you need to be steady even during the downturns. And this, there could not be any better example of why these kind of advices are so common. uh, See, the stock market is all about discipline. Discipline is baked into the stock market operations all over the world. You can refer to even the most underdeveloped, probably the most corrupt country in the world, and their stock markets still have the kind of discipline that is seen all over the world. What do I mean by discipline? All over the world, stock markets open on time, they close on time. Okay, in India, the pre-market session is the market opens at 9 a.m. for pre-market session, and 9:15 a.m. for all investors, and it closes at 3:30 p.m. No matter how big an investor is, no matter how well connected an investor is, that person cannot just call up the stock market and say, I'm stuck in traffic, can you just, instead of 9:15, can you open at 9:30? That just doesn't happen. Similarly, no matter how big or powerful a businessman is, or how well connected that businessman is, that person cannot just call up the stock market and say that you should work on Sundays also. The way he can call up his employees, his or her employees, and make them work on a Sunday or a holiday, that just doesn't work when it comes to stock market. So a stock market runs on discipline. Discipline is baked into the very operations of stock markets, and hence only disciplined investors will make money in a stock market over a long period of time. So this is what it all comes down to, right? You have to choose the right schemes that fit your investment goals, schemes that fit your risk profile, and then let time work in your favor. So this is why you need to consult a very good mutual fund advisor who can select the right schemes for you, and then guide you through your investment process. Don't be alarmed by short-term market movements. See, it is the very job of the news media to report news, right? Although I just wish they could probably use a little less drama in their reporting, or avoid using words like bloodbath and things like that. Uh, but anyway, I mean, it is their job. They're reporting what is happening in the market, but you don't need to be affected by all these fluctuations. Let the fund manager worry about your money. If you have chosen the right schemes, if you have done your homework before investing, you don't need to really get panicked by every 5%, 10% kind of a crash. Sometimes ignorance is bliss, and this is the example of that. Don't check your portfolio NAVs on a daily basis. Uh, at the most, do a very brief quarterly review of your portfolio, and if there is some really glaring discrepancies, such as some scheme which has really not performed well, then only probably you can discuss it with your advisor. But even then, as I have been repeatedly saying on this channel, that do not redeem your investments, or do not kind of think about switching out of a scheme just on the basis of, say, 6 months, 9 months, or 12 months of performance. You need to do your homework before you invest money in a particular mutual fund scheme. But once you have done that, once you are convinced that it is a good scheme for you, you need to give every scheme in your portfolio at least 2 to 3 years before you take the decision of switching out, or choosing some other scheme. And this is another example. This I had given during our long-term orientation video also. And this is how the HDFC Flexi Cap Fund has performed since Jan 1995. Now remember, this is not an investment recommendation. This is for illustration purpose only. Excellent graph showing that how the market has crashed in between. But people who kept faith, people who had invested 1 lakh rupees in HDFC FlexiCap Fund in Jan 1995, and kept that money intact without redeeming any of it during various market crashes that have happened over the last 3 decades or so, they would have seen those 1 lakh rupees grown to nearly 2 CR at a CAGR of almost 18.9, nearly 19% CAGR over the last 30 years or so. So that is what it is all about. You need to have a long-term orientation, you need to have patience, and you need to have belief, you need to have discipline if you want to make money in the stock market. If you are planning to start your mutual fund investments, you can contact me on this number, 9757309269. That is my WhatsApp number. I would definitely help you in choosing the right schemes that fit your investment goal, investment horizon, and risk profile. Thank you for watching this video, and do subscribe to this channel for future interesting videos on the topics of mutual fund investing. Thank you.